It seems like Federal Reserve may be repeating a familiar mistake, setting monetary policy without fully relying on the current economic data. This is risky and could push US into a recession. The latest CPI figure highlights the concern. The overall CPI rose 2.4% year over year in May, unchanged from March, and slightly up from 2.3% in April, while the core CPI remains steady at 2.8% for the past 3 consecutive months. If you look at the PCE, which is Federal Reserve's preferred inflation gauge, overall PCE inflation year over year is up 2.1% in April. The core PCE is up 2.5%. With inflation nearing the 2% target, the Federal Reserve should be moving interest rate closer to the 2.5% neutral rate. However, it has held the Fed funds rate steady for 3 consecutive FOMC meetings already at 4.25 to 4.5% level. It seems the reason the Federal Reserve isn't cutting interest rate is due to uncertainty surrounding the tariff policies implemented by the Trump administration, an issue Jerome Powell and other members have repeatedly cited. They have emphasized waiting for clarity on tariff before adjusting policy. However, this approach is problematic. Tariff uncertainty is a future risk. Basing monetary policy on future expectations repeats Fed's mistake during the pandemic, when it undermined inflation by calling it transitory. Instead, the Fed should focus on current economic data. When the inflation falls, especially like what happened right now, consecutive reports of having an inflation near the target, the policy rate should be cutting accordingly. Another issue is that Trump has a track record of rapid shifting policies, making it unrealistic to wait for a clear picture. The picture never gets clear. There will always be uncertainty under this administration. The indefinite inaction is not a viable strategy. Another issue is that no one can accurately predict the future. It's a fact the Federal Reserve should fully acknowledge, especially after the mistake they made during the pandemic. While tariffs are generally expected to raise inflation, however, that outcome isn't guaranteed. Even within the Federal Reserve itself, there are different views. For example, Minneapolis Fed advisor Javier Bianchi is working on a paper called the Optimal Monetary Policy Response to Tariffs. Stimulating the economy could take precedence over controlling inflation, and that's one of his key arguments. The reason is that although tariff raises consumer prices, they also trigger a negative demand shock, which could offset those price increases through demand destruction. Federal Reserve's inaction also raises concern about Federal Reserve appearing to overstep its role by indirectly involving itself in fiscal policy, because when federal officials publicly ties interest rate decisions to so-called tariff policies, it can come across as saying, because of your tariff policy, we won't cut rate, implying that a change in the fiscal policy could trigger a monetary response. This creates a perception that Federal Reserve is holding monetary policy hostage to influence fiscal policy, which undermines its own independence. As a central bank, the Fed should avoid or minimize commenting extensively on fiscal matters and stay focused on data-driven monetary policy. Right now, there is an escalating military conflict in the Middle East, with Israel targeting Iranian nuclear sites and military facilities. This raises serious concern about potential strikes on Iranian oil and gas infrastructure and the possibility of Iran blocking the Strait of Hormuz, both of which are pushing oil price higher. On June 13th, the day of the attack, WTI crude oil futures spiked to $77 per barrel. Based on Fed's recent behavior, it's likely that they will reference this conflict in the upcoming June FOMC meeting, citing geopolitical uncertainties as a reason to further delay the rate cuts. They may argue that such tension could push prices higher, so we will choose to wait and see rather than act based on inflation data. On June 15th, Trump spoke to an ABC News reporter about the possibility of U.S. joining the conflict with Iran. It's unclear what the involvement might look like, whether it's limited to supplying weapons like bunker buster bombs to Israel to help attack the underground nuclear facilities, or does this include direct military actions? So this will potentially give the Fed another reason or excuse to not cut interest rate. According to the latest CME FedWatch tool, markets are pricing in a 97% probability that Federal Reserve will hold interest rate for the fourth consecutive time at 4.25 to 4.5% during the June 18th FOMC meeting this week, and a 80% chance of holding again for the fifth time on the July 30th meeting. This suggests that the Fed is once again setting monetary policy based on expectation rather than current data, a very risky approach. It's unclear why the Fed is acting this way. Maybe it's because of Trump's earlier threat to replace Powell. But regardless, the current strategy appears to be increasingly risky. Thank you very much.